All right, let's talk about different types of taxes for compulsory income. All right, so the first thing we'll look at is state and municipal tax types. The first one we'll look at is real property tax, and this is present in every state in the United States. The tax rate, which we'll talk about a little bit later, is set at the local level. It includes real property, so whatever is developed or erected or even growing on the land in some capacity. So think about houses or buildings, facilities, agriculture in some sort, in some cases. So an important thing to look at is at one point, these type of taxes, these real property taxes, represented 70% of the revenue generated by at the local level, and now that's about 30%. So with that, we look at personal homes, undeveloped land, businesses, farm property. So we want to make sure that we understand that they're taxed at different levels. So, your house is taxed at a different level than if you owned a farm with agricultural or horticulture businesses going on. Undeveloped land, like if you just have a couple of acres of a wooded or pasture or whatever that's not doing anything really, that's taxed at a different level than your house or your business property. And there are some permanent tax exempt status that may be granted to certain type of land uses, such as school districts, charitable organizations, religious facilities, and stuff like that. There are also tax abatement programs that give exemptions to paying taxes in some cases. So this is usually used as an incentive to attract business to an area. So if we're looking at, Tesla recently was looking at Tulsa and Austin as far as where their next location was going to be for business. And there's a lot of things going into that. But both Tulsa and Austin developed a program that they gave, a set of incentives to move there. And this is basically what this is. We're allowing the forgiveness or reimbursement of taxes based on if they'll move a certain type of businesses. And this is based on job creation and some other things, right? We can look at property tax values. So how do we move forward with that? We can look at real property value is the market value. So, your house is worth whatever somebody is willing to pay for it. Usually the assessed value of that type of property is slightly lower than the real property or the market value. And that's all determined by the jurisdiction or the body that's going about making those assessments and those valuations. All right, so let's look at a quick example. We have a house, and we pay $240,000 for that house. That's the real market value. That's what we agreed to buy it for. And we figure if we agreed to buy it, that's probably about the level that somebody else would buy it as well. The fair market value is an assessment of that real market value at 85%. So we say we're gonna say the fair market value is 85% of the real market value, and then that brings it to about $204,000. This is part of the local tax base. So what we really need to think about is what is the total local tax base? It's the total assessed value of all the taxable property in a community or a geographic boundary that they've set up, right? And it's almost it's impossible to compare different communities to one another as well. Just an FYI. So we're going to move into the tax rates, and I said we were going to cover this. So tax rates are based on the revenue needs of the government. So whatever the government needs, it needs to adjust tax rates in order to cover those things. And we look at the tax base. So let's work through an example here. We need about $3.6 million to operate our local government, right? Let's just say that's the city of Johnsonville, for example. Johnsonville needs $3.6 million. We have a revenue of about $600,000 through user fees, grants, permits, etc. Throughout the year. So really what we need to do for Johnsonville is we need to collect about $3 million, right? Because we offset it. So our tax rate is determined by dividing the property tax requirements by the assessed valuation. So when the tax abatement property is removed from the total assessed value, what remains is a net assessed value. And I know this can get a little complicated. I won't fret too much about it. I just want to give you an introductory to it to kind of go along with what you're going with in your book. All right, so we're moving forward with our example in Johnsonville. So we gather all the buildings in our whole community, like every community, every building that's taxed, right? So we have an assessed valuation. We assess them all, and we add them all up. So our total assessment for the entire community or the geographic boundaries, $450 million. That's what we say everything's worth in our entire community, right? And then we take out those tax exemptions that we gave out for whatever reason, right? We say, oh, we gave this facility a tax exemption, whatever. So let's just say that we had $10.5 million in tax exemptions. So overall, our net assessed evaluation for the community is that $439.5 million, right? That's how much our community is the net assessed valuation. All right, so the tax rate is based on our net assessed valuation here. So what we're going to do is we know we need $3 million to operate our community of Johnsonville, right? The following formula will help us get a tax rate, and we'll move forward with that tax rate as we go forward with this. But we need $3 million. That's the required taxes we need to get. Our net assessed valuation for our properties are that $439.5 million. We're going to divide 3 million by 439 million. So we're going to get a tax rate of 0.0068. Okay, so with our rate that we just calculated, there are 3 different ways that can be expressed, right? The first one is a percentage of the property value. So it's if we have 0.0068 was the valuation or the percent we just got, we look at a percent tax rate and it's 0.68. So we can say that we're going to tax your property at 0.68. Then we can look at a mill rate, and we'll talk a little bit more about that. But we use the mill rate is the 0.0068 that we calculated, or we can look at it as mills, and we look at 6.8 mills. And we'll kind of go through that a little bit more here in just a second. So let's think about this a little bit further. So 0.68% means 0.68 per 100. So we look at that as 0.68 over 100. That still equals our 0.0068 overall, right? So we're still working with that number. So a mill, which is a term used in this calculation, is equal to 1/1000th of the assessed property value. So let's go back. Our net assessed property value for the entire community is $439.5 million, which means the value of 1 mill is going to be that number divided by 1,000. So a 1 mill is equal to $439,500. Again, I know this kind of gets a little complicated. Let's just follow with me so that you have a little bit better understanding of it all. Okay, so what we want to know is how many mills does it take that are valued at that $439,000 does it take to make the $3 million to be collected from taxes so we can run Johnsonville, right? And what we're looking at, if you look down at the formula below, we need $3 million, and each mill is 439,000 per se. That means we need 6.8 mills to get our money to run Johnsonville. I found this graphic on the World Wide Web, and I thought it was really good and a real neat way to show this. So if we look at tax rate and we move from tax rate to mills, we're going to multiply it by 10. So if our tax rate is 0.68, our mills will be 6.8. If we move from mills to tax rate, we're multiplying by 0.1. And you can look at this overall on how we move from one to the other. So really, I know we use the word mills and mill rate. It's all just a tax rate, and we can use this to kind of figure out and move between terminology. So there are also some other type of taxes that we're going to look at. We can look at personal property taxes, and that's allowed in most states. So a lot of times this will include tangible property for businesses. Then it may look at intangible products such as stocks and bonds, and sometimes household tangible property as well. Then we can look at sales tax, and this is allowed in most states, and it's administered at the state level. In some states, there are allowances for additional local sales taxes. So you'll see sales taxes range from 4 to 11 and 12% total for everything you buy. Then we have a use tax, and this is imposed on purchase items made outside of their state of residence, where there's no sales tax. So if you're buying something online and you're getting it from a different state, and it's coming into the state. So there's no sales tax per se. They can do a use tax on that as well. And then we can look at income taxes, and we can look at corporate and personal income taxes. So this is, of course, administered at the federal level for personal income tax. Sometimes personal income tax can also be at the state level. Some states don't have personal income tax. And then some municipalities also do income tax as well. Corporate taxes are a little bit different. They can be, of course, at the federal level, but sometimes the state and local levels will do that a little bit differently, depending on the state and municipality. We can also look at local option taxes and special assessment taxes. So each one of these is going to be added to sales tax or otherwise, but it's enabled at the state level to allow local municipalities to leverage to get more taxes. So with the local option taxes, this is usually added to the sales tax, and it's become very popular for special projects. So we're going to add a 1% tax to make sure that we can rebuild the rec center or get a new community building or something of that nature. Special assessment taxes are usually done in a variety of ways. They usually focus on a certain area, such as downtown or a residential neighborhood, and tax revenues can only be spent in that designated area. So I know in Tulsa, Oklahoma, they have the River Park system, which is along the Arkansas River there in Tulsa, right? And if there's a special tax that goes specifically for that development of that area. So that's a pretty good example. You can check out, there's a lot of other ones, I'm sure, but you can check that one out. All right, so we'll conclude with talking about other compulsory income sources. Dedication ordinances and regulations are usually available to local governments, and they're typically facilitated institution by city and county councils or groups. They require developers of neighborhoods to set aside a portion of land or funds for park development per se, so we have some green space for a new neighborhood. The tax is a form of recovering development costs for new neighborhoods. So in the same thing, let's look at impact taxes real quick. This is another method of recovering development cost. So it's intended to require developers or new homeowners to help pay for their public improvements, right? So if there's a new neighborhood and we have to expand the sewer treatment of that area, or we have to expand the water delivery system in some sort. So overall, existing city residents that already have all that shouldn't have to pay for the new development as far as the expansion of those services. So these impact and these ordinances and stuff like that help offset those costs for these and through these new developments. And that concludes our discussion about different types of taxes.